Yo, 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 guys. So we have Lit Nomad coming in here with a new video called Quant Explains How the Rich Exploit You. So quant, short for quantum computing. So this guy was in high level trading at the, I assume, hedge fund level, doing some quantum trading here. So let's see how the rich exploit you in his opinion.
As a quant and anyone who works in finance, you know that people don't price things correctly in the market in general, and that's why you make money because you price things better than them, so you know when to buy and when to sell. But I want to apply this to life, and in life, right? People don't price things correctly. So like a lot of people are afraid of flying, and so they'll be like saying prayers at the airport and like thinking they're gonna die. But like the drive to the airport, you're like 1,000 times more likely to die there than on the flight itself. Like there's a lot of data on this. So that's just like an obvious example of how people don't price risk correctly. And in prop trading and hedge funds, we're basically exploiting that flaw in human nature, but in financial markets. But that's like a topic for another time. I want to talk about how people are always triple long and they don't seem to realize it. So triple long, what do I mean by that? You know, there are like triple long ETFs, like S&P 500, triple long ETFs. You can look this stuff up, but it's basically like it's as if you're like three times as long that position. And people are generally triple long in their life, and they don't realize it. What do I mean by that? They're long their job, they're long their stock or equity within the company.
All right, guys, if you're not super aware of what long and short means in the investment world, essentially, long, to make it very simple, means that you believe in its continuous growth or its continuous success. And short, right, if you were to short a stock, means that you believe in its imminent downfall. You believe that the stock is going to go down and it's not going to grow, it's going to become worse in a sense. And if you're long, you believe it's going to be better, or get better or grow in some sense. So that's what he's explaining. And three times long, triple long, it means you have basically that level of confidence threefold. And he's saying that it's misjudged and it's misplaced where we put our confidence in the real world. So let's see kind of how he breaks this down.
Or RSUs, and they're long their home, their real estate. So it can go your way and it can go against you. In Silicon Valley, right? A lot of my friends ended up there around 2010, and a lot of them are just like average smart guys, but they got into some big tech firm and they have more money than me because they bought a home there and they got into this big tech firm and they have equity at their firm. So their equity shot up like 500% or more, and their home shot up like 500% or more. And times are good, so their salary just keeps going up, and promotions are handed out and so on. And so, when times are good, but when you're triple long, what happens when times are bad? So I have a friend who worked as an engineer at ExxonMobil, and she was at the plant outside of Chicago in Illinois. And ExxonMobil had a pretty big contraction at one point. This might have been like 5 years ago, 10 years ago. Anyways, they basically closed that plant outside of Chicago. And so they laid off everyone at that plant, or they gave them the opportunity to relocate to their Houston headquarters. And so a lot of people have their families there and their kids in the school districts, and they weren't willing to do that. So they just got laid off. And what happened is they lost their job when these announcements came out that ExxonMobil is like closing factories. The stock sold off by like 50% or something.
So this is what he means by long, right? Your confidence in it continuing to do well or grow. It also could be looked at as like holding a position for a long time versus holding a position for a short time. So when you're holding a position for a long time, you don't expect and you're not really truly prepared for headwinds that are going to kneecap the whole investment or the whole position or, for example, your career. And in this example he gives, it was either get laid off or relocate. And if you're entrenched in your neighborhood or community, then that's a harder, it's not just the easiest decision for people to make, especially the way they make it sound. It's like, oh, we're not really firing you. You know, you're not losing your job. You just need to move to some state place you've never been to, nor do you want to go. So it can have its own challenges, but let's see where he takes it.
And you have a lot of equity in your own firm usually because you get to like buy into them at a like discounted rate or whatever. So they all their equity in Exxon lost 50%, and then their homes lost 50% because they closed that plant, and that plant was the major thing driving the local economy. So a large percentage of the employees like lived in those neighborhoods outside of that factory. So that's an example of when you're triple long, how you can get steamrolled. And I think a lot of these people didn't realize that, especially with like mortgages, you're inherently leveraged because, well, I'm sure you guys know how mortgages work. So you can be underwater after that, right? When your home loses 50%, you're most likely underwater, in fact. So yeah, my friend was lucky because she was doing like a reverse commute from Chicago. So she just bought a condo in South Loop, which kind of held its value. South Loop didn't really go up that much, but at least it like went sideways. But all of her peers who bought in the suburbs closer to that ExxonMobil factory, their homes lost 50%. So that's sort of that's sort of the point I'm trying to make. You know, you think you're managing your risk correctly, but you're not. You're exposed to a triple long risk. You're exposed to career risk, equity risk, and real estate risk.
That's one of the things that people in our generation, millennial, Gen Z, zillennial, a lot of times we don't calculate risk. We grew up in times that were good, and we haven't truly needed to calculate risk because a lot of the things that our parents grew up telling us, go to school, get a job, work, and you'll be able to afford, the American dream, is no longer the case. And so there's actually a risk in pursuing the standard old, what's the best way to say it? We're in the gig economy now, and this came from the industrial age, and we're in the information age now. So the industrial age advice is riskier today in the information age. But when the industrial age was prominent, let's say the 30s through the 90s, then that advice was perfect. But nowadays, from the 2000s to 2020, it's the information age. Things are changing rapidly in ways that people that grew up in the industrial age can't truly predict, see, or comprehend sometimes.
And no one tells you this because all the people involved in these industries want you to continue putting your money in them. So it's sort of like I wouldn't say a cartel, but it's like people are colluding together. Different parties are all colluding together to keep you in the dark about your inherent risk. And this is a large risk, and I just want people to know that. The reason I chose prop trading as an industry is because prop trading is inherently counter-cyclical. So what I mean by that is that it does the opposite. So when the market is grinding up, bonuses are small because markets are calm and there's nothing to trade because prop trading firms make money off of price inefficiency and panic. And when the markets are crashing and the economy is, really not doing well, prop trading firms make their biggest money. Prop trading firms are feast or famine in that way. And it's actually quite beneficial to be in a counter-cyclical industry because you get your biggest bonus when the markets are crashing. So like the guys at Getco who made their biggest bonus in 0809 during the financial crash, like traders there made like first year traders there made $1 million bonuses. Like you can look this up. And they got their bonuses in like January, and the market bottomed out around February or March 2009, like around SPOO 666. So imagine you get your $1 million bonus there and you sock it into the market there. It's up almost 10x from there. And that's just stocks, right? If real estate is more your taste, people's home prices halved or worse. and they're losing their jobs and they need to panic sell. And I mean, it's predatory, but you can put in a low ball bid and just, say, hey, you sure, you want to sell this to me? Like, you don't want to default, right? It's bad for your credit. And then people will just puke out of their homes and sell like 10% lower than mid market. And, you know, Fed's lowering interest rates because the markets are crashing, and they're trying to stabilize the market. So you can get like a 30-year fixed rate mortgage at like 2% and put in a lowball bid and scoop up some like great real estate at huge discounts. So those are the hidden benefits of working for a countercyclical industry. You have money when other people don't have money, and that's actually like wildly important.
There's something deep about having money when other people don't have money, and he kind of explained part of it and said it was kind of predatory. It is in a way, but when people don't have money and you do, you have the opportunity to truly change your life. For example, in 2011, when the real estate market was at the bottom, you could buy homes in, I mean, maybe not the best areas, but you could buy a whole home in, like, let's say San Bernardino, California for under $100,000. I mean, these are like SUV prices, right? To get a whole home. And then just 5 years later, those homes are shooting up to two, three, 400,000. And today they're sitting at five, six, 700,000 potentially on the size and how many bedrooms. So the opportunity to buy things and take advantage of the market when you have money and other people don't is huge, because now, I mean, trying to buy the same home, it's not even close to the same price. And now you'd be buying it when people do have money. But we're going to go through another cycle. It's been a silent recession that we're not really feeling yet. But eventually, blank's going to hit the fan.
And it's like when everyone's on the same side of the canoe and it tips over. Like, you don't ever want to be in that situation. You want to be doing the reverse commute, right? So when everyone's in traffic, stuck on the other side, you're just flying down the highway going 80. There's like a huge hidden benefit to being like in a countercyclical industry. Prop trading is the best example of a countercyclical industry I can think of, but the media is another example, right? Like they complain about Trump when, like, oh no, Trump's president, but they were actually like salivating because like viewership and CNN and all those mainstream news channels went up like crazy because everyone's like, oh no, is the world gonna end? And they made a lot of money from that. And another countercyclical industry I can think of is like pharmaceuticals during the pandemic. I'm sure there are others, but prop trading is the cleanest example I can think of. I'm not triple long, right? My net worth might be in the S&P or real estate, and when the market crashes, my happiness is hedged because I know that my net worth is contracting, but I'm going to get one of my biggest bonuses that year, and I'm going to be able to take my bonus money and put it in the market somewhere near the lows. And so my wealth is hedged and my happiness is hedged as well.
Okay, so not everybody is going to be in such a high level position with understanding exactly how the market works and how to take advantage of the market and do exactly what he was talking about, hedging his wealth. But what you can do is you can learn from this and understand that it's like this old quote. I'm going to forget who said it, but I'm sure somebody remembers. But they say to be scared when everybody else is happy and be panicking when everybody else. No, I messed it up. I'll find the quote. I'll find the quote.
And then on the flip side, if if it's just like the markets are dead and quiet and just quietly drifting up for a couple of years in a row, they might have layoffs at prop trading firms because there's nothing to trade. But jobs are plentiful elsewhere because the economy is roaring.
Be panic when everybody is greedy and be greedy when everybody's panicking. There you go. That's what you want to do. That's what he's explaining, and that's how you can take advantage of it, even in your own life. My goodness, I struggled there.
So you can easily pivot into like being a data scientist in big tech or something. So you're hedged in that way too. You're, it's easy for quants to kind of like jump from like quant finance, elite finance to big tech, from like quant to like data scientist or something. People do it all the time. Like Citadel quants jump over to be like Uber data scientist, and they do it the other way as well. It's kind of like the high paying industries. The smart people at the high paying industries just bounce between them depending on like which sector is doing well. So yeah, I would encourage you to consider that aspect of how you manage the risk in your own life. Sorry, one final point. Wealthy people understand that normal people are triple long, and they don't want to be triple long. So what they do is they invest in hedge funds. And so why is it called a hedge fund? Because they're hedging your risk. There's a well-known bet that Warren Buffett made where he said, "Oh, I bet the S&P will outperform these hedge funds." Yeah, buddy, like we know that. We know that. We're taking 30% as a cut. So there's that. But two, we're not investing in correlated asset classes as the S&P, real estate.
Correlated asset classes, for those that don't know, means that if you're investing in real estate, the correlated asset class would be something that correlates to real estate. So if you're not correlated, that means if the S&P goes up, you're not going to experience the same gains. But that's the whole point of a hedge fund, is to find the other opportunities outside of what everybody else is doing. And that's what he's explaining here.
Most people don't know this, but even flight to safety asset classes like bonds and gold, they all crash when the market is panicking because there's deleveraging happening. And so you're really not safe anywhere. And so where do wealthy people put their money to diversify? They put them in hedge funds because hedge funds use unique strategies that are actually not correlated with all of the known investment classes. Like, go look at the price of gold, bonds, like during major crashes. They all sell off. But with certain hedge funds, they won't. They'll go up. Because hedge funds are inherently uncorrelated with major products. They'll short, right? There's that movie with Seth Rogen where his hedge fund was picking individual equity names and shorting them.
Oh, that movie's called Dumb Money. It's pretty good. Seth Rogen and the guy from Bitcoin, the Kitty guy. What's it? Turbo Kitty, something Kitty. You guys know what I'm talking about. He made a bunch of money off GameStop stock. Got a bunch of people hyped up during the pandemic around that area. What was his name? It was something Kitty. Something Kitty.
That's the kind of thing a hedge fund does, because that's uncorrelated with performance of the broad market. And so, yes, you're going to give up a little bit of performance because it's hard to find an asset class. It's hard to find some kind of investment vehicle that is uncorrelated with the broad market. The broad market is the easiest way to generate returns because you're basically investing in the labor of intelligent people who are trying to grow the firms they work at for their shareholders.
That would be like the S&P 500 or the Dow Jones. For those that may not be familiar, the S&P 500 are going to be the top 500 companies in the United States. And then you're going to have the Dow Jones, which is going to be the top 30 companies. And you can invest in all 500 companies at once by buying either a portion or a whole share of the S&P 500. If you guys want to know how much it costs to buy a whole share of the S&P 500, go on your phone, check your stock app, and you will see that it has risen to basically $6,000. Right? Look at it 10 years ago and see how much it's risen, so you can kind of understand what it looks like to invest in the general market.
And, basically all the smart kids in your high school are now running companies, and you want,
Hold on. I don't know what high school my man went to. If anybody from my high school is running a company, let me know. Actually, they won't even see this, so I don't know how they'll let me know. But I need to go find that out because, brother, I should have went to a better high school.
You're basically betting on those horses. Like, would you bet on them to get an A on their school project? Of course you would. They're the smart kids. Well, those smart kids are now, running these companies, and they're using all of their intelligence to try to grow these companies and make them more profitable. So Being long the market is just doing that. You're just betting on all the smart people who run the Fortune 500 companies to continue to grow them and use things like technology to, you know, increase profits and, lower expenses. So, anyways, that's a tangent. But like, yeah, I just wanted to drive that point home about hedge funds. Hedge funds are called hedge funds because they hedge against the mainstream risk that you have by putting your money in all the well-known places, real estate and stocks. And wealthy people know that. They know they know that you're triple long and they think you're a sucker, but they're not triple long. They own.
Yes, wealthy people do think that the average investor is a sucker. They call it retail investing for a reason, and we will break down on this channel why that's the case and why retail investing has been so sugar coated, watered down, and wrapped in bubble wrap to protect the so called commoner that it's not even the highest nor close to even the most worthwhile performing investment that your money could be placed in. But they assume if you lose all your money in a more risky, more sophisticated investment, you won't have the wherewithal to make that money back because you have an employee mindset and you're just earning by trading your time for money. So there's not enough time in the world to make back, let's say, $250,000 if you were to lose it in 1 hour in a bad investment. So you can see why retail investments watered down. It's basically kid safe, foolproof, 3 and above, not a choking hazard. You know what I'm saying? So, yeah.
Own real estate and they own stocks, but they also put a large percentage of their wealth in hedge funds. So when the market's crashing, their wealth is just kind of going sideways. They're diversified. And it's very useful to always have bullets. It's very useful to have money when other people don't have money.
He said bullets. I was like, what? It made me think I got that stick on me. Like, what is he talking about?
It's very predatory, but you can snipe off really good deals when other people have to panic sell.
This is very true. This is very true. If you have to panic sell your home and you can get it on a fire sale, you can buy an appreciating asset on a fire sale. These are amazing things. And this is why they say cash is king, especially when you need it.
And they were overextended and they need to unload properties. They need to unload their businesses, and you can scoop them up at a big discount. Wealthy people know this. That's why they invest in hedge funds. All right. See you next time.